Besides this ongoing trade war with the US, which looks like it will last a long time and also escalate, China is now copying the US with fake economic data, which they learned from the US, QE, quantitative easing, and even plunge protection teams to boost up China's stock market, and I will talk about that in a minute with an article I just found in the last week or two, and also a new and large share buyback scheme, which they also learned from the US. Share buyback with debt, which probably won't be paid back. So let's talk about how China is now copying the US in many different ways besides just stealing intellectual property, and there's reports out that China has been stealing $200 billion to $600 billion worth of research and development and intellectual property, basically in exchange for cheap trinkets for many, many years now. Trillions of dollars worth of theft. So, the new Chinese share buyback plan. This article came out on Zero Hedge on May 16th. It says Chinese buyback soared to all-time high as foreigners dump a record amount of stocks. It's not just the US that is set for another record year of stock buybacks, into which both institutional and retail investors are selling, with 2019 already experiencing the worst start to the year for equity fund flows since 2008. It now appears that China, too, has learned how to goose up stocks on the back of a massive surge of buybacks. But first, some perspective. Echoing investor activity in the US, investors have also ramped up their selling of Chinese stocks, and ever since the Shanghai Composite peaked in late April and tumbled in the subsequent weeks. In fact, as the Wall Street Journal notes, quote, foreign investors are offloading shares listed in Shanghai and Shenzhen through Hong Kong's flagship Stock Connect platform, end quote. Specifically, in just the last 20 trading sessions through May 14th, or ever since Chinese stocks peaked and then suddenly slumped, foreigners have been selling China's A shares with gusto, dumping some 52 billion yuan, or around $7.5 billion net of purchases, the largest amount on record. While the selling is perhaps to be expected in light of the recent Chinese stock slump, it marks a change for China, where overseas investors had barely ever sold equity on a net basis through the Stock Connect system before. As the Wall Street Journal's Mike Bird notes, last year when the MSCI China A Offshore Index fell roughly 31%, which, by the way, there's articles that came out from investigative reporters that the Chinese government put pressure on Morgan Stanley to include more Chinese stocks in there to keep them boosted, and that caused the Chinese stock market rally. There's articles, I've talked about this in the past, where the Morgan Stanley people were basically pressured into doing so. The drawdowns lasted no more than a few days and ran to a fraction of the size of the current one. Quote, the shift could be related to the fact that access has been progressively widened to allow more buying and selling, end quote. This is a problem because, as the Wall Street Journal notes, 2019 was meant to be the year many Western investors began buying Chinese stocks, end quote, and while inflows could well return later in the year, the current reversal shows that China's recent index inclusion won't be enough to sustain, there's some grammar errors here in the Zero Hedge article, won't be enough to sustain permanent inflows to China, end quote. The traffic won't all be one way, end quote, but instead will be contingent on stock performance. So in other words, momentum chasers. In light of such an aggressive liquidation by foreign investors, one would expect China's plunge protection team, or quote, national team, end quote, to be especially active in propping up stocks, and yet in the first quarter that has not been the case, as the following chart from Goldman Sachs shows, although in recent days the national team appears to have turned, quote, incrementally more active, end quote. Meanwhile, domestic investors quite active in late 2018 have been far more muted this year, with over 150 equity mutual funds liquidating in 2019. So there's been a spike in margin debt too recently, so it looks like there's some cross currents. So with foreign investors dumping and domestic investors hibernating, who is buying Chinese stocks? The answer, which will hardly come as a surprise to US traders, is one well known: stock buybacks. As Goldman calculates, similar to the US in 2019, A-share buybacks surged in the fourth quarter of 2018, first quarter of 2019 to $90 billion RMB ever since the CSRC announced new rules to support share repurchase in last November. And a chart looks like it's increasing a lot. So just like in the US, even as most marginal traders have been selling stocks, the price indiscriminate buying by companies repurchasing their own shares has exploded, not only propping up the market, but allowing the Shanghai Composite to close the best performance of any major market. How sustainable such record repurchases are remains to be seen. Finally, one last way that the Chinese market action in 2019 has been eerily similar to that of the US is that as companies have been buying back record amounts of stocks, insiders have been liquidating. In fact, as Goldman calculates, insiders have sold close to RMB 50 billion A shares in the past 3 months, and a further RMB 1.9 trillion of lockup shares will be released in the second half of 2019. What does this all mean? Well, as long as rates are low enough and companies can continue to sell bonds and use the proceeds to buy back their own shares, the world's credit investors have become the de facto anchors to both the US and Chinese stock market. Incidentally, this is merely the latest reason why rates simply cannot go up. When companies can no longer afford to sell bonds and buy back their own shares, that's when the next big move lower in global asset prices will begin. And so no wonder why so many yield curves all over the globe are inverted. This stock buyback scheme, the share buyback scheme, seems to be global. Even Lael Brainerd telegraphed this from the Fed. So Chinese are copying the US in a lot of different ways now. It's not just IP theft. It's not just fake economic data. This article is from May 10th from Bloomberg Quick Take by Moxie, M-O-X-Y Ying. I'll attach a link to it. The article's title, When Stocks Crash, China Turns to Its, quote, national team. It rose to prominence when China's stock market imploded in 2015, spending billions of dollars on equities as authorities scrambled to stem the losses. Media and market watchers regularly refer to it, but it's rarely mentioned by Chinese officialdom. There were even questions last year about the desire to keep it going. But worry not, Chinese stockholders. The, quote, national team, end quote, is here to try to save the day. 1. What is the national team? It's a nickname for the collection of state-related bodies that Chinese authorities lean on to buy stocks during times of turbulence. State-owned corporations have been purchasing shares since long before the 2015 crash in China, but the precipitous fall that year, the Shanghai Composite Index dropped more than 40% from its peak in the space of 2.5 months, stoked fears about the stability of the financial system itself. That prompted a government-directed splurge on mainland shares, or A-shares, as well as the injection of liquidity to some asset management companies. 2. Who are the key players? Goldman Sachs Group defines the national team as government-related entities formed during the 2015 turmoil, as well as, quote, those that already existed before the market crash, but were actively engaged in the A-share market during volatile times, end quote. Although opinions differ, the following are often cited as key team members. China Securities Finance Corp., founded in 2011 to provide funding to the margin trading businesses of Chinese brokerages. Next, Central Huijin Investment Limited, part of China's sovereign wealth fund and established in 2003 to invest in state-owned financial enterprises. During the 2015 rout, a unit, Central Huijin Asset Management, was created to buy equities. Next, the State Administration of Foreign Exchange, the foreign exchange market regulator. Almost sounds like one of the other plunge protection teams here in the US, the way it was named. Another one, the government's National Social Security Fund, some state-backed brokerages. 3, why the concern about the national team's future? During the 2015 meltdown, 5 mutual funds were formed to purchase stocks with about 200 billion yuan or $30 billion equivalent from China Securities Finance Corp. Those funds, however, were reported to have liquidated in 2018, leaving traders wondering about the status of the national team at a time when the stock market was in freefall. It didn't help that an article by a state think tank had called for the exit of the national team. But in a rare acknowledgement of its existence, China's securities regulator said in October that the market had misinterpreted news about the funds selling their holdings, assuring investors that, quote, relevant institutions, end quote, had actually increased their position. So the market manipulation, the plunge protection teams in China had actually bought more Chinese shares. Analysts speculated that the government had redistributed money from the funds to other parts of the market. 4. How much market presence does the national team have? Goldman Sachs estimates the national team held about 200 billion of mainland stocks as of second quarter 2018, making up 5.8% of freely traded shares. While that's significant, it's also the case that the national team was much less visible in the market in 2018, with few signs of heavy-handed intervention, even as the Shanghai Composite Index fell about 30% from its peak. The national team was in action again in May. State funds were said to step in as shares dropped after U.S. President Donald Trump threatened China with steeper tariffs, ramping up tensions in a trade conflict that many investors had hoped was nearing an end. And there's just a lot of news stories coming out that it looks like the trade war is nowhere near ending, with many Chinese, it's been reported, either breaking their iPhones or switching immediately due to marketing campaigns in China. 5. How effective is the national team? Market participants say the mere knowledge of a big buyer provides a confidence boost when nerves are jittery. That's especially important in China, a rare market where retail investors dominate trading. The national team helped equities to find a bottom in early 2016, but more recently, long-suffering investors have again been disappointed. The Shanghai Composite was one of the world's worst performing benchmark stock indices in 2018, falling 25%, and the amount of money traded each day on China's exchanges has never recovered to pre-2015 crash levels. 6. Do other countries prop up their stock markets? So this article is going to be incomplete. It only talks really about Japan. So it says, yes, Japan's central bank spent 2.4 trillion yen, or around $22 billion, on bank stocks to stabilize the financial system from 2002 to 2004 and 2009 to 2010, according to Asian Development Bank Institute. More recently, it's been buying exchange-traded funds as part of its stimulus program. In 1998, Hong Kong's government bought billions of dollars worth of equities to stem a market rout. Taiwan set up a fund to support stocks in 2000, and South Korea is planning to do the same. What's different with China is the sheer scale. It was reported in 2015 that in order to avert the meltdown, China Securities Finance Corp had access to as much as 3 trillion yuan of borrowed funds from sources including central bank and commercial lenders. So interesting stuff, guys. Did you listen to my little mashup at the beginning? I played around with that with some voice control stuff, and I used Alvin the Chipmunk stuff with an argument back and forth. So if you didn't get a chance to hear that at the beginning and you're coming into this live stream late, definitely go back and listen to the replay after the show's over, and you're going to get a giggle. It's about 7 seconds worth of pretty funny laughter. And I'm making fun of the US and China, guys. You know I'm making fun of all governments for doing this nonsense. Happy Memorial Day weekend to our American friends. There's another article I wanted to talk about. So this is from the New York Times on April 16th of this year, 2019. Article is entitled, China's Economy Stabilizes After Beijing Opens the Bank Vaults. China's economy stabilized in the first 3 months of the year, according to the official figures released on Wednesday. So last month, after Beijing flooded the financial system with money in a whatever-it-takes approach to arrest a slowdown. Officials said that the Chinese economy, the world's second largest, grew 6.4% in the year's first quarter compared with the same period in 2018. The pace matched that of the fourth quarter, when growth suffered as shoppers pared back, the stock market slumped, and private businesses pleaded for help. While economists generally regard China's economic figures with skepticism, my friends on Wall Street have other words to say about that. They point to signs that the country's current slowdown may have reached bottom. Other figures suggest shoppers are back at the tills, factory output is ticking up, and the world, after several tough months, is buying more Chinese goods. Beijing needs such hopeful signals as it tries to reach a trade deal with the Trump administration while under pressure to lift conditions at home. So you know this article is a month old because Beijing has basically backed away from the trade deal, and they're hunkering down and they're planning on a long and escalating trade war. Officials, quote, spared no effort to put the policies into effect, end quote, and growth in the first quarter, quote, laid a solid foundation for the stable and healthy economic development of the whole year, end quote, said Mao Xingyang, a spokesman for the National Bureau of Statistics. National Bureau of Fake Economic Data, just like the U.S. has a Bureau of Labor Statistics, which is also phony economic data and economic propaganda. There is a caveat. The signs of improvement most likely do not stem from a sudden burst of confidence in the strength of the country's economy among Chinese business leaders. Instead, the positive glimmers are largely a product of the hundreds of billions of dollars that Beijing has pumped into the country's economy in recent months, as well as the loans that officials have pressed state-run banks to make to businesses. All of that comes at a cost. And it raises a question about how willing Beijing is to spend to keep growth going. I think they're willing to spend unlimited as long as it's in RMB. Dollar-denominated debt is another issue. But as long as they can spend almost as much as they want in RMB. As long as they can maintain the currency exchange rate favorably, not let it go crazy. If China were to go to 8 or higher RMB, my sources in China said that their inflationary expectations and velocity money would pick up, and there would be a lot of money trying to get out of China. There's already money trying to get out of China, and there's a lot of capital controls, but my source, who is living in China for the last 10, 15 years, says it would escalate as the RMB got to 8 to 9. And yes, it was like that in past years, about 15, 20 years ago. However, China did not have the credit bubble it has, did not have the real estate bubble it has, did not have the debt problems it has. The household debt in China has grown exponentially in the last 20 years. Quote, this time they used an overwhelming amount of force to boost the economy, end quote, said Larry Hu, chief China economist at Macquarie Group. Quote, "This is why the economy stabilized in the first quarter," end quote. "The chance of a double dip is in which growth drops again before picking up later this year is high," Mr. Yu added. Quote, "The recovery is not that solid," end quote, he said. Quote, "They front-loaded the policy firepower at the start of the year," end quote. The data on Wednesday also revealed that state-owned enterprises picked up much of the slack in economic activity, with investment from those industrial giants rising while investment by private companies slowed. In many ways, China's policymakers are reverting to an earlier approach, doling out more loans in exchange for a short-term increase in confidence. The strategy helped keep growth surging over the past decade, even after the 2008 financial crisis. But it left the country awash in debt that threatens to hamper the economy in the years ahead. In the early years of China's boom, companies and local governments could borrow liberally, knowing that accelerating growth could help ensure that their gambles paid off. Now that the country's economy is huge and maturing, it has become increasingly difficult for China to simply grow its way out of debt. Quote, "China already is in the midst of the largest credit bubble the world has ever seen," end quote, said Victor Shi, an associate professor at the University of California, San Diego. And Professor Shi added, "The Chinese government has not been able to wean itself off its debt habit." Quote, "The government simply cannot afford to think about the medium term and must focus on short-term continuation of the credit bubble," end quote, he said. The latest round of government-driven financial largesse was remarkable in size and scale, economists said. The broadest measure of new borrowing in China, known as total social financing, jumped to $1.2 trillion in the first quarter, while bank lending hit a record high of $865 billion, according to central bank statistics. So that increase in China stimulus, the QE program, some of that money got out. And Danielle DiMartino Booth thinks that some of that money got out, and that's what helped boost American stock markets. It's tough to say because the capital controls are very difficult in China, but some of it may have gone out one way or another. Local governments, encouraged by the central government, raised $100 billion in new money through special bonds, compared with just $11.5 billion in the first quarter last year, when the same local governments were scolded for borrowing too much and hiding their debts. So it sounds like a 180-degree reversal. This money, it's inflate or die. It's credit bubble or die in China. This money started to show up in the economic data on Wednesday with a jump in spending for massive infrastructure projects like toll roads and new subway lines. On Tuesday, the Organization for Economic Cooperation and Development warned of the potential hazards of such heavy borrowing, saying it could yield bigger economic imbalances in the future. The organization revised its outlook for China's growth to 6.2% for this year and 6% for 2020, citing the heightened risks of a housing collapse and growing geopolitical tensions. Even as it struggles through an economic slowdown, China is in a, quote, major driver of world economic growth, end quote. I'm going to screw this up. Schukennecht, the organization's deputy secretary general, said in a report, quote, "Yet China is at a crossroads, facing serious domestic and external challenges to maintaining its strong position over the long term," end quote. Mr. Schukennecht said. The organization also warned that the country's trade war with the United States would weigh on exports and overall growth. As it searches for engines to power growth globally, the world needs China to pull through economically. Last year, Beijing reported that growth had softened to its slowest pace since 1990, amid mounting signs that the trade war was already beginning to take a toll, spooking investors. New export orders dropped to multi-year lows, prompting factories to cut overtime and send workers home early before the Chinese holiday season. The world can now turn once again to Chinese shoppers. If the data this quarter is any indication, Chinese shoppers helped to push retail sales up by 8.3% in the first 3 months of the year, though car sales were still low and the figure was unimpressive by the standard of the past couple of years. Quote, "Early signs that consumption growth may be stabilizing is really the big story," end quote, said Sean Roche, chief economist for Asia Pacific at S&P Global. Companies also appear to have more resources to hire and expand in the first 3 months of the year. Some of this was a result of a pledge last year by the central bank to pump $175 billion into the system, mostly to help small and mid-sized companies. Although the data remains weak for manufacturers, the sector saw a double-digit jump in revenue in the first 3 months of the year compared with the last quarter of 2018, according to the economic consulting firm China Beige Book. Making deep cuts to corporate taxes is among the new policies Beijing hopes will stimulate economic activity. The State Council, China's cabinet, has announced a series of such cuts that are expected to free up $300 billion to help jumpstart the economy. Tax cuts are normally only temporary, though. We'll see what happens. Because when you have that much debt and you have that much currency devaluation, inflation, the tax cuts are like supply-side economics, similar to what the Trump tax cuts. The Trump tax cuts, notice, with that much debt in the U.S. economy, didn't really last too long. I'm in favor of tax cuts across the board. The problem is government spending has to correspondingly cut. And there's just too much debt throughout all of society, even in China, and especially the US, but all over the globe at all levels of society. If its current measures do not work, Beijing could try more unconventional policies to stimulate struggling sectors like the property market. That sector, which by some measures accounts for up to 30% of China's economic activity, I've heard a lot more than that, Jim Chino says I think almost 70%, is saddled with too many unsold apartments and many unfinished development projects. The slowdown in property sales and the glut of empty apartments, 65 million units, according to one estimate, have started to worry economists. New housing starts this year down from the same period last year. Land sales also dropped in the first quarter and could continue to fall. Construction and investment data on Wednesday showed early signs of a turnaround. Prices of homes stabilized, and investment in the real estate sector rose at a faster pace than last year over the same period. Chinese officials have said they have a handle on what they see as a modest slowdown. I don't think it's modest. Economists say the government still needs to get the debt problem fully under control. You can't get the debt problem under control. They created almost $50 trillion already in 10 years. Quote, this rally and savings are being replaced with debt in a lot of cases by many Chinese households. Quote, this rally didn't appear out of nowhere, and quote, analysts at China Buyback wrote, and there are at least 3 compelling reasons to doubt its staying power. Credit, credit, and credit. I agree with China Buyback analysis. Addressing China's expansive monetary policy on Wednesday morning, Mr. Mao conceded that, quote, downward pressure on the economy still exists, end quote, both from a global economic slowdown and from what he described as China's own, quote, structural contradictions, end quote. He added 6.4% is still less than last year's full year growth, end quote. Yeah, and the 6.4% is bogus. It is phony economic data, just like the US. And I think there was a Chinese professor who recalculated the GDP, and he said it was around 1%. And I think he got in trouble, or his speech got erased from the internet. At least Chinese social media was deleted. So I read these articles for a point that China is looking to copy the US even more. And they actually even, as you saw, announced a bank bailout, although it was a small one, but we'll have to monitor to see if there's going to be additional bank bailouts announced. I was surprised there was a bank bailout announced, because normally the Chinese do not publicly announce these things. I was surprised that Reuters in China was allowed to announce the article, because normally the media in China is not allowed to do things like that. It's just very weird, everything that has been going on lately. Okay, a couple more things before I let you guys go for this short show. We're only at 22 minutes. I read a couple articles. I will attach additional articles for you to read if you want to go even more in depth. But this other thing I think was very interesting from one of my friends that I follow on Twitter, another financial professional. So, with the 20-month period during which Michael Bloomberg, rich champagne socialist Michael Bloomberg of the Bloomberg Terminal and of Bloomberg Media and of all these restrictions on sodas and calories and all this other garbage, will take a global bond index worth $54 trillion and assign 6% solely to the top 4 Chinese state-owned enterprises and policy banks. And then he is literally taking Western savings, because pension fund money and other money, index fund, passive investing money, will be allocated and giving it to the Chinese Communist Party to the tune of an incremental $3.24 trillion worth of additional funds. Worth of additional funds for the Chinese Communist Party. And this is at a time when, according to Kyle Bass, China's trade reserves, the reserves that they've accumulated over the years, which at one point was over $4 trillion, and they didn't have that much debt, is now down below $2 trillion. And China, according to Kyle Bass, is running twin deficits. They have budget deficits and current account deficits. So the trade war is really starting to hurt China. So we'll see how they escalate. It's been mentioned rumors of, because President Xi, or Emperor Xi, visited a rare earths facility this week, and I covered that earlier this week about the rare earths and potential for the problems with that. And things are just keeping escalating here at this point. But that additional, if that is true, that additional $3 trillion, that will really help China out. Because China has a dollar-denominated debt problem, they need dollars. They need those dollars to pay off their $2 trillion plus in dollar-denominated debt that their private corporations and state-owned enterprise have. And they need those dollars to go buy commodities. They need those dollars to buy oil. They need the dollars to buy food commodities like soybeans and things. And they need the dollars to buy metals like copper and other stuff. So we live in very interesting times. I think that Chinese proverb is also meant as an insult, too. So China is now copying the US with fake economic data, quantitative easing, a plunge protection team, which appears to be increasing the amount of intervention and market manipulation it's doing. Even state-owned enterprises, according to that Bloomberg article, are now that have no business buying certain shares. Even some Chinese oil companies are buying regular Chinese stocks, A shares. Bank bailouts, which every country does bank bailouts, but it was rare for China to announce one, even though it was a small one. But the thing is, with the small one, there could be enormous counterparty risk. And just because on its website it says that they only have $20 billion worth of assets, in reality, it could be much, much different than that. Could be 10 times, 20 times, in reality, more than that. And their counterparties could be larger, more well-known Chinese banks. This is the contagion, domino effect, daisy chain world we live in now. So if the wrong bank fails, and even if it was a little bank and the stupid bankers, the greedy and stupid bankers made some really dumb bets and thought that they could get rich quick, they could potentially collapse the banking system in their country. Or if it's a large enough bank, like a Deutsche Bank or something like that, it could do immense damage to the entire global economy. China's debt to GDP ratio now is around 300% debt to GDP. I've seen estimates varying from 270% to 300%, but there are no signs that the credit bubble is slowing down. In fact, every time credit drops, they come up with new plans, new schemes to increase credit again. And the share buyback plan, it looks like it's in the tens of billions of dollars now for the share buybacks. So it's tens of billions of dollars worth of share buybacks to prop up their stock market. And I don't know, probably similar to the U.S. corporation situation, that those share buybacks aren't going to be paid back either. Will interest rates go up? Maybe on people on Main Street on credit card rates, but banks and corporations and governments, especially the larger governments like the G6 and G7, they're manipulating it. Because if you look at the charts lately, almost all the yield curve on the 10-year for many different countries is inverted. So that's active market manipulation, and that's active financial repression. It's an attempt to invert all the yield curve and flatten it out and manipulate it down to keep the global credit Ponzi scheme going as long as possible. Johnny says, Communist China has always made up propaganda. I would say they have gotten better at copying the US for economic propaganda. The economic propaganda has gotten more sophisticated. Rob, thanks for the super chat. He says, better than a university level 101 course. Hey, Rob, this is better than an MBA program course. You know why? Because I was teaching some of these courses when I was in MBA. I knew more than my professors did in a couple of the classes, and I was wasting my money there. There was a stock options trading class, and the professor was just reading this stupid book, and he didn't know anything he was talking about, and he never traded any options before in his life. I seriously had a MBA professor who worked for the Bank of, I think, Zimbabwe. I think he was a central banker, and he had worked at the Bank of Zimbabwe during the hyperinflation. And he came to the U.S. as a legal citizen, and then he gambled on subprime housing, and he went bankrupt. And he was telling us, our people in the class, about it, and said he had no choice. He thought he had to buy a house, even though he knew eventually he wasn't going to be able to afford it. He bought it anyway. It's really sad. A lot of the degrees are not worth the paper they're printed on. So we have all these. The bottom line is China's copying the U.S. in many different ways now, with market manipulation, intervention, credit bubble, economic propaganda. And I want to mention this because a lot of people don't know about it. There was a book called In the Plex. It's a book about Google. And it's a book about how things worked at Google initially and the co-founders of Google. And Sergey Brin, who was one of the co-founders along with Larry Page, Sergey Brin's dad, before they moved here to the United States, before they escaped the Soviet Union, guess what his dad was in charge of? His dad was an economist in the Soviet Union, and the dad was in the economic propaganda department. And the dad was in charge of coming up, and they were testing these out with new statistics, new formulas, new equations, changing the numbers, changing the data, changing the formulas, all these different ways to make it look like, number one, there was no inflation in the Soviet Union, and number two, that the Soviet Union standard of living for Soviets was a lot higher than the standard of living for Americans. So the government's attempts, whether it's the United States or the Soviet Union or the China Communist Party and everything in between, they're always looking to cheat. And if you study financial history, whether it was clipping gold coins or switching out clipping gold coins, or switching from gold to silver, or clipping silver coins, or what the Romans eventually did was they switched to copper coins and then they dipped them in silver, and for a while that fooled people. So governments, whether it's fake economic data or currency devaluation, the history of governments is quite clear. The governments normally, especially the larger ones, the larger governments like the empire type ones, do not traditionally default on debt. They lie, they cheat, they steal, they do economic propaganda, they do currency devaluation in one way or another, and this appears to be what the game is. So it's stagflate and tax and lie, manipulate the markets higher, don't let them crash, and keep the game going as long as possible. And again, before I wrap things up, definitely go back and listen to the first 7 seconds or so of the really funny mashup I did with the Alvin the Chipmunk voices of the two little kids arguing that, no, your economic data is fake. Your economic data is fake. No, your economic data is fake. I think it's hilarious. Okay, guys, well, that's it for now. Everyone have a nice rest of your weekend, and I'm going to go relax. It's time to eat some barbecue. Okay, bye.